my friends, and happy Tuesday to you. On our last podcast, we discussed why credit scores really matter. Today, we will tackle some of the myths about credit that could cost you money. Allow us then to separate credit facts from credit fiction and save you thousands of dollars. So, if you're ready, let's talk Tuesday. Myth number one, a negative credit score follows you forever. The negative information on your credit report stays there for 7 years, but like athletes who get old, their impact diminishes as it ages. I know a little bit about something like that. So, if you started out missing payments at age 21, but got your act together, bought a house and a car and paid them off on time, in your mid-40s, you won't be forever judged for your youthful indiscretions. Myth number two, checking your credit score hurts your credit. Checking your own credit score is considered a soft inquiry and does not affect your credit score at all. As we explained earlier, though, multiple hard inquiries by financial institutions investigating whether to extend your credit are the ones that hurt your score. The impact isn't that great, however, so don't let it dissuade you from applying for a home improvement loan if your roof is caving in. Myth number three, rent payments help raise your credit score. Now, traditionally, rental payments were not factored into credit scores, but new credit scoring models by FICO and VantageScore have begun to incorporate rental data. The problem with that is that many lenders prefer the old scoring models. In addition to that, FICO estimates that less than 1% of rent payments get reported to credit bureaus. And finally, rental payment data is primarily used to improve credit access to those without credit history, not to boost the scores of those who already had a history of making credit card payments. And understand this, landlords rarely, if ever, will report positive rental payments. However, there are services that you can use to report your own rental payment information. Myth number four, credit scores are universal. That means you have one score that every lender checks. That's sort of true. FICO scores are used in 90% of lending decisions. Problem there is that there are now 10 FICO scores and 6 or 7 variations of each one. There are also scores that are calculated by 3 national credit bureaus, Equifax, TransUnion, and Experian, each of which uses a similar but slightly different method. In other words, if you have a bad credit score with one bureau, you're going to have a bad score with all of them. Myth number five, your spouse's credit score affects yours. Your credit score reflects only your financial transactions. So just remember, if you and your spouse or anyone else jointly apply for a loan, lenders will look at both scores to determine credit worthiness. Myth number six, a high salary helps you with a credit score. A good income makes it easier to pay bills and improves your chances of getting a loan. However, Credit scores are not based on your income. So whether you make $10,000 or $100,000 a year, what matters is whether you pay your bills on time and don't run up more debt than your wallet can handle. Myth number 7, your age matters. Good news, Botox users. Credit bureaus track a lot of numbers, but your age isn't one of them. There could be an indirect link to your score, however. Younger people generally make less money and have less experience with credit, and that could lead to financial mistakes. But older people will be penalized just the same if they made the same mistakes that the younger people do. Myth number 8, there's a credit blacklist. Credit bureaus simply collect data and assign scores. It's up to individual lenders to decide whether your score meets their qualifications. So there is no secret list. Everybody consults. If you keep getting rejected, it's because you've blacklisted yourself. Myth number 9, every missed payment impacts your credit score. Utility companies, cell phone providers, and insurance companies routinely check your credit score before extending service, but they usually don't report your payment information to credit bureaus. So if you fall behind in those payments, they usually just cancel your service or coverage. But sometimes a company will pass overdue accounts to a collection agency, and that collection agency will report the missed payments to credit bureaus and damage your score. Minor issues like parking tickets, library fines are not reported to credit bureaus. If your conscience doesn't bother you, you could probably get away with keeping an overdue library book. Myth number 10, your employer can see your credit score. Employers can access credit scores, but only if you're giving them permission. No permission, no access. They can look at your credit report. Myth number 11, it's hard to improve your credit score. Well, it can be, but there is help available. Nonprofit agencies offer credit counseling and programs that can ease the struggle. Millions of credit-challenged Americans have found relief through debt management programs. There were counselors who worked with lenders to help lower your interest rates. And your monthly payments can be combined into one payment. Myth number 12, your credit score doesn't matter. Now, if you believe this one, you've probably never tried buying a car or a house to get insurance or anything along those lines, because for all of those things that you're trying to purchase, you definitely need a credit history. Either that, or you may be rich, and so you don't give a darn about a credit score. But a high credit score not only improves your chances of getting a loan, it means you'll be getting a lower interest rate. And if you think that interest rates don't matter, ask your accountant about that. For instance, if you took a 30-year mortgage, $300,000, with a 3.5% interest rate, your monthly payment minus taxes and insurance will be around $1,349 a month. If you had a 5% interest rate with the same data, your monthly payment will be $1,613. So in real terms, that means you'll be able to buy 63 more Big Macs a month if you had a lower interest rate. Now, of course, if you actually did that, you'd probably die of a heart attack before the loan was paid off. And we definitely don't advise that. And I'm just adding a little levity to our conversation, but understand how credit and credit scores work and its impact on interest and interest rates are important. A lower score may tell lenders a person is not likely to pay back a loan, resulting into an increased APR or annual percentage rate. That equals more money out of your pocket. So recapping, the primary factors that affect your credit score include payment history, the amount of debt you owe, how long you have been using credit, new or recent credit, and types of credit used. So now you know that credit is part of your financial power. So you want to protect it. It's time to meet with your financial professional to get you started on your way. And if you don't have a financial advisor, or if you need a financial coach to help you develop a game plan or a winning strategy to build wealth, do give us a call at 937-889-9809 or try emailing us at the Academy of Financial Literacy at gmail.com. And finally, our ministry is changing lives. And I want to thank you for partnering with us to help stomp out illiteracy in our community. Your generosity helps the Academy of Financial Literacy educate the community and equips us with all the knowledge and skills to manage how to manage our money more effectively. So I want to bless you for blessing us with your gift. Join us for our next podcast where we will discuss how do you know if you are financially fit. Until next time, let's talk Tuesday.